For most Americans, the day you retire becomes the day you have more control over your taxes than any time in your life. But you got to know the strategies. You got to know how the most affluent Americans in this country position their wealth so that they get to make the decision on when they're going to use their money, how it'll be taxed, and more. Today, I'm going to show you how to ensure you don't let the IRS dictate your IRA strategy. Keep it right here. Good day, everybody. Chris Heerlein here of REAP Financial, host of Wealth Radio on News Radio KLBJ, host of Retire Ready TV every Wednesday at 6 p.m. during the 6 p.m. news hour on KXAN. Thanks for making us part of your day here. If you like our channel, hit the subscribe button down below. Most people with significant assets in their IRAs and 401ks, they let Congress and the IRS determine their spending and their distribution strategies. This is a big mistake that can cost them and their families quite a bit of money over the years. According to a JP Morgan asset management study, most Americans don't begin taking money out of their qualified retirement accounts until required minimum distributions say they have to take it. In past months, I've dropped many videos on our YouTube channel and discussed how the RMD rules really are a tax trap for many middle class and upper class households. The longer distributions from traditional IRAs and 401ks are delayed, the higher the lifetime income taxes are likely to be on you and your heirs. In so many cases these days, you may need to let go of the idea that distributions shouldn't be taken until the government says you have to. Congress, they set the rules for their benefit, not yours. And as I reviewed last month, it's not always a good idea to defer taxes for as long as possible. I know that's ingrained in many of us, but it's important in the retirement years to shift from the savings mindset to the distribution and spending mindset. We want our families at REAP Financial to create a thoughtful spending and distribution strategy. Here's another finding from that JP Morgan asset management study. While most of the people didn't begin distributions until required and only took the RMD amount, those who took distributions earlier, this is surprising, they tended to have more wealth than the median. Could be a number of reasons for that, but I suspect it's because more than likely they have professional advisors and followed their advice. Over the years, I've run the numbers and found that because of the way RMDs are compounded, and especially because of the rules that your heirs face, it can be very expensive to leave money in traditional qualified accounts for too long. The problem is especially seen with people who have sufficient income and other assets to pay their retirement expenses. You got pensions, you got Social Security, maybe you're not needing to touch it, so you view your traditional retirement accounts as maybe an emergency saving or legacy money for your heirs. The result is that you and your heirs pay significantly more income taxes and stealth taxes on your Medicare as a result. To reduce your lifetime taxes and have more family after-tax wealth, consider repositioning your IRAs and 401ks. The strategies that are most profitable when you expect income tax to be higher in the future, but at the same time, these strategies can give you more control. If you're like me, I do believe taxes will be higher in the future. As of the date of this recording here in 2024, taxes are as low as they've been in 40 years. So you might find that one strategy or a combination of strategies may suit you best. But the idea of reducing your IRA early is the starting point. Years ago, I ran the numbers and concluded that some people should take money out of their IRAs before RMDs kick in. They may need to take the money to pay expenses or maybe not. But by doing this, you're paying income taxes today at historically low rates, and then you're investing the after-tax amount in taxable accounts, brokerage accounts. Traditional IRA distributions are always going to be taxed as ordinary income. If your IRAs currently are invested in long-term capital gains or qualified dividend type of approaches, you're converting tax-advantaged income into ordinary income. That's not a good strategy. Over the long term, it can be better to have the money in taxable brokerage accounts than letting it just sit there and compound in the IRA to be only taxed at ordinary income later at what could be higher tax rates. And when it comes to your kids or your heirs, they also are likely to be better off inheriting taxable brokerage accounts. Traditional IRA distributions to your kids, your beneficiaries, they're taxed just as they would have been to you. they're taxed as ordinary income, but when they inherit after-tax accounts, brokerage accounts, this is where it gets tax favorable, okay? Because when they inherit brokerage accounts, after-tax accounts, the heirs, they increase the tax basis to their current market value when they inherit them. They can sell the assets and owe little to no capital gains taxes at all when they do so. All the appreciation during your lifetime escapes taxation in this situation, giving your heirs the benefit of the full value of the assets. Another powerful strategy that many of our successful clients use, they convert IRAs to Roth IRAs. It's probably the most used strategy today. And it's part of a well-coordinated plan to transition part of your traditional IRA to Roth. As you know, so I suspect most of you know, you pay tax to convert the IRA, and that money is included in your gross income at the end of the year. So you want to be strategic with this. You don't want to do too much or too little. But a conversion not only produces tax-free growth, but it also gives you control because there's not any RMDs on these Roth accounts. So it gives you control. And then after the 5-year waiting period of conversion, you can then distribute income and gains to yourself, your kids, whomever, tax-free. Now, when you leave these beneficiaries that I'm talking about, these Roth IRAs under today's law, they have to distribute the entire Roth IRA within 10 years after inheriting it. Now, I've been discussing pros and cons of IRAs conversions and the best times to do conversions on our YouTube channel here for years. There's another strategy, when we think about the conversion game, but one of the things I want to just speak about here is that you can convert any amount you want. There's no limit. There's no number of conversions you can or can't do. If you have any money in an IRA or 401k, you can get in the conversion game. And some people, they convert just enough each year to avoid jumping into the next or higher tax bracket. The thing I recommend is you sit down with a CPA or a fiduciary advisor with our team, and we can help map out a coordinated strategic Roth conversion plan. It's really powerful when all these things come together when you're looking at not just the conversion, but how these conversions can impact your Medicare, impact your Social Security taxation, and more. Another little known strategy, as I sum up here, is to turn the IRA into permanent life insurance. Some people out there, they may reap more benefits by repositioning their traditional IRAs and 401ks into life insurance. What they do is they take distributions from the IRA, they pay the income taxes and deposit the after-tax amount with the insurance company as life insurance premiums. So when you reposition the IRA as permanent life insurance, it can have several advantages. Number one, the life insurance payout received by the beneficiaries, when that's left to them, it goes income tax-free. The heirs benefit from the full value of the policy. The amount your loved ones inherit with life insurance is fixed by the contract. We can know how much we're leaving the heirs. It doesn't fluctuate with the markets the way that an IRA balance can. With some types of life insurance, the benefit might increase over time. The life insurance benefit is also likely to be more than the current balance of the traditional IRA and almost certainly will be more than the after-tax value of the IRA. Now, details with this strategy, they vary with your age, health, and the type of permanent life insurance you purchase, but you might have lifetime tax-free access to the policy when you're alive through policy loans, accessing the death benefit while you're alive to use for lifestyle, to use for long-term care, home health care down the road, and more. And these loans that you're taking, they aren't repaid. They're not going to be repaid until you pass away. And then whatever loan balance is outstanding would reduce the final life insurance benefit left to the heirs. These loans come out and they are assessed a stated rate of interest, but depending on the type of carrier you're with, that will determine and oftentimes the interest rate along with what's going on with the Fed. You can do that systematically through the years. You can also take a one large distribution from your IRA, use the after-tax amount to buy the policy in just a single premium. Or you can take, like I mentioned, regular IRA distributions, maybe your RMD each year, to pay the annual premiums with the after-tax amount. So these are just a few of the ways we structure our family's wealth and their planning. And I want you to get your hands on our retirement income planning checklist where we talk about these ways to garner control how we do it directly, and a lot more. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com. We'll send our retirement income planning checklist directly out to your inbox. As always, thanks for tuning in today. If you like our channel, be sure and subscribe. Catch you next week.